Okay. One more reminder for everybody who's on here. I see an 8 to 12. I see an Alec. I see a Donna Ray. Make sure Donna Ray is probably Demarie's mom. Hello, Donna Ray. Make sure that you go to participants, your name, more, rename. We got to have your full name for the Segway giveaway. So right after this call, I promised my San Diego team that they would watch the recording, I'd give them like 30 minutes after they get off the doors to participate in that. And then I will be posting the Segway giveaway in the school and tagging the winner. So we do a little like spinny wheel thing, and it's totally random, but we're gonna be giving away the Segway. So make sure you've got your name on there. Somebody's gonna win the Segway, and it's gonna be good. Guys, taxes. So we had a lender on 2 weeks ago, Taylor, and that was an awesome call. And Taylor did a great job, and he got us all really, really excited to work hard, to make a lot of money, to buy some real estate, to get ahead. And it was amazing. And hand in hand with lending and banking and making the money is taxes. And taxes are one of the most painful, just hellacious parts of making money. It's most people's like biggest expense, and especially as you start making more and more money, it can be your biggest expense. And you can't buy real estate without mastering the tax game. And inversely, you can't buy very much real estate unless you figure out how to um, try and pay a little bit less in taxes. Like it is such an important part of investing and learning to make money and growing as a business person and all those different things. Like incredibly, incredibly important. I have like a horror story that I briefly told Travis about before this, and some of you have heard it. But when I started making good money, and especially like the last 3 or 4 years, I've always had an accountant, and I've gone through two or three different ones, and I had found one that I really liked. It was a group called High Country Finance, and they were awesome. And they were doing my bookkeeping, and they were doing my rental properties, and they were helping me out as a real estate agent, and they were doing all these different things, and it was great. Um, but the guy who owned High Country Finance sold the business, and shout out to him. I'm sure he made a nice check and rode off into the sunset, and we celebrate success here. So I'm so happy for him. But in selling the business, the guy who was doing my taxes transferred. And the guy from High Country Finance had told me that I would, probably pay around, 50 or 60 grand in taxes. And that's a lot of money. And even that hurt. But I had made more that year than I had ever made before. So I'm like, oh, I know that as you make more money, your tax bracket goes up. And I didn't buy as much real estate as I should have. And I'm like, oh, I guess it just is what it is. It hurts, but, got to pay to play. So I pay 60 grand so that I can avoid penalties. The guy sells the business, and this new accounting firm takes over. And when it comes time to pay taxes, it's like a mad rush. And he's just sold the business. And I'm like, well, crap, I got to figure this out. So I'm emailing them every day, and I'm begging for them to help me. And it's a train wreck. I can't get a hold of anybody. And anyways, I finally end up getting a hold of someone, and they're like, hey, you owe 90 grand in taxes. And I'm like, well, why did it go up 30 grand? That doesn't seem right. But it's the last day. It's the last day after my extensions. Like, this is October 15th. It is the last day. I'm like, all right. So I sent another 30 grand. And I'm like, that sucked. Hopefully I can go back and figure that out once I have a little more time. I get a bill from the IRS a month later for another $110,000. And I'm like, what? What is going on here? Like, what happened? And come to find out, the new accountant had intended to tell me that I owed an additional $90,000. And in the time period between when I paid the 30 and I got this next bill from the IRS, they had tacked on a bunch of fees and a bunch of fees from when I was supposed to file in April, and my tax bill had just grown exponentially. And long, arduous, messy, painful story short, essentially in the change of accountants, they had missed a bunch of stuff. They had missed a bunch of my cost seg. They had added in some extra income. They had missed a bunch of my interest and things like that. And it just was a mess. And I've been able to work through it. And I think I'm only going to end up actually paying like $40,000 to $50,000. So I'm actually going to end up in a great spot. But essentially, the IRS has held on to at this point like $150,000 of my money that I'm paying interest on because I had to borrow to pay it because I've been buying so much real estate for the last like 12 months. And it was a giant wake up call for me that taxes are arguably the most important part of your business. Like each of you guys is a little mini business owner. As you go out and do sales, as you do whatever it is that you're doing, you're a little mini business owner. And especially as you start buying real estate and you have multiple properties and you're growing that way, you are a business owner. And if you don't have your taxes in order, if you don't have this part of your team in place, it can literally cost you everything. I have another good friend, and I won't say his name because I don't think he would want me to share it, but I have another good friend that got in some tax trouble, and he ended up owing the IRS over $1 million in taxes after a few years and after an audit. So this is one part of the equation that you do not want to mess with. And as you make more money, as you do this job for longer, as you get ahead, it becomes like the most important part of the equation for you. So that's my horror story to get us kicked off. But Mitch.
Yeah, we're excited to have a expert give us the rundown of the do's and the don'ts so you don't do what Yogi did because I was along the ride with Yogi and just his lows where he called me and said, dude, you won't believe it. I have to pay this. Oh man, it was wild. So, but we're excited. Thanks everyone for joining. The goal of this call is once again just to level up everyone and helping educate and in the end get into real estate. Like that's what we want to do. We want everyone to get into real estate. Yogi nailed it on the head. Texas taxes are a huge part of that. So we're gonna pass the time over to Travis. There's several people at Aptive that are big hitters that use Travis. And I got told to Travis, looked at his Instagram, called Travis, and realized, holy crap, this guy's good. He works with a lot of door-to-door guys, and he knows what he's doing, and he knows how to strategize. He's into real estate, and he's been doing this for several years. He was in small banking, so he'll tell a little bit of his story. But we're really excited to have Travis on and give you guys a rundown and especially with you guys starting. The reason why we wanted a tax person right now is because you can't. I mean, you kind of can, but you don't want to be thinking about this way after the summer. Like if you know what you're going to make and you know an idea of as you start selling a lot of accounts of the income you're going to be producing, you want to get ahead of the game and you want to make sure you have your LLCs set up and you get your ducks in a row before. So anyway, Travis, excited to have you. We'll pass the time over to you.
Thanks, Mitch. Appreciate you. Can you hear me okay?
Yeah,
Loud and
perfect.
clear. Sweet. Awesome. No, I appreciate the introduction and appreciate the time and having me on. And I have a lot of respect for the door-to-door industry. I think everyone are hustlers, right? You have the mentality of being something better. You want to grow yourself. You want to help other people grow, which we've seen with Mitch and with Yogi, helping you guys grow, giving this platform for free is unheard of, right? I work with a lot of business owners. I've been in a couple of Alex Hormozzi's workshops. I have some business partners that's been in his workshops, and if to have a free school group is unheard of, and I think these guys are providing that value. So that is huge. Um, I wanna kind of dive in and give you an overview of what exactly we do at my firm, what I do with my clients, what that process looks like, really how it's different from a lot of your traditional CPAs and accounting firms. I want to start with kind of the reason I got into this. Mitch alluded to me being in small banking and stuff like that, and so I myself was audited. It was on a lot smaller scale than, Yogi's example of his friend and himself. But it was kind of a wake up call of really what the IRS is all about, what the Internal Revenue Code is all about, and um, yeah, I ended up paying some fees. The accounting firm that I wanted to go back and have them help me, eh, I couldn't get a hold of them, right? And so there was nothing I could do besides pay the IRS what I supposedly owed them, right? There was no way to even double check that I did owe them. And at that time I was in banking and so I started focusing on the tax side. Before it was accounting, right? I have a background in accounting, and And then going into banking, a lot of it was the finance side, the financials, getting small business owners, lending, looking at their financial statements, eventually trying to work my way into the private bank. But I started realizing very quickly as I started connecting with some guys in the door-to-door space that there's just a big lack of information and education when it came to taxes, when it came to business structures, when it came to finances in general. And so I started working with this team a little bit, diving into some tax strategies, some business corporate structures, and started seeing it play out to make a big impact on this team and these individuals. And so I really just started focusing on the door-to-door industry. One, because again, I love working with this industry. I have calls all the time where it's you guys are saying what your goals are, what you're trying to accomplish, and it's fun to work with those type of individuals that have aspirations, want to be something better, and again help other people be better. You don't get a lot of that in the business world. So door to door is very unique because of that. Yogi alluded to something that each one of you are mini business owners, and that is so true. And with that, there comes liability, there comes responsibility, and so I want to kind of break something down here for you. Can I share my screen? I think I have to send the request. So I'll try and share again. Sharing is not turned on. Oh, there we go. Presenters. Awesome. Okay. So here is kind of a little setup I created. I've had and diving into what most firms have and what most accounting firms and CPAs have is a system that is perfected in accounting, right? CPAs are phenomenal. I do not bash any CPAs. They've gone to school to be great at accounting. In your guys' situation, in most 1099, most small business owners, accounting really isn't the problem, right? You guys are great at going and making money and selling and closing people and creating these relationships, building teams, and but with a traditional accounting firm, with a traditional CPA, they ignore a lot of your questions. It's hard to get a hold of them. There's one meeting at the end of the year. Hey, here's your potential tax bill. They send you the tax organizer, the tax packet. Okay, we filed your taxes. We'll see you next year, type of thing. And it's true. I feel that a lot of them work for the IRS because they don't want to get audited. They don't want to go through that process. Like in my situation, when I do get audited, they're not there to help, right? And so it seems like they're doing the bare minimum to try and not raise any flags, which is great. I think for the most part. Um, Here at Ziva Ventures, that's the name of our company. We've set it up to where we are here working for you. Our focus is to empower you as the business owner, as the client, to make sure you are set up in the best way possible, right? And so we've set up systems to where anytime you send a message, it's answered quickly, right? That we're working with you throughout the year to make sure that we have those strategies in place for you throughout the year, and we end up having monthly and weekly meetings most of the time. And so this is kind of what we focus on, and I'll move through these pretty quick because I want to get to the real estate side and kind of talk about the fun stuff here. So, we focus on the business structure optimization, the Ron rule, right? I think that's what a lot of people miss is because you're many business owners, anything that's reasonable, ordinary, and necessary in pursuit of income is a deduction, right? So we can dive more into that too as well. We focus on retirement, tax-free wealth strategies, corporate structures, trusts, those kind of things, and turning hobbies into businesses. So business structure optimization, a lot of you guys know that's S corps, right? Looking at what an S corp can save you. You establish an LLC, a limited liability company, for the protection. And some people might think against this, and you may have been told this, that, oh, you shouldn't set up an LLC until you make over a certain amount. The LLC is not for tax savings. The LLC is for liability protection. You are an independent contractor for the company that you're selling for. Therefore, all the liability is on you directly. Having that LLC gives you a little layer of protection. Being taxed as the S Corp is what saves you that money in this example here, which is that 15.3% in self-employment tax, which we can kind of dive into when we connect one off. Again, the ordinary and necessary expenses, these are all things that are tied to your business, right? I think the joke is, oh yeah, put it on the card. It's a write-off because I'm in the door-to-door space, right? Which is legitimate. It's true, right? You are the one that decides what is deductible and what's not. And that's why Section 162A in the Internal Revenue Code is so crucial to business owners, is because it gives you the ability to write off what you deem reasonable, ordinary, and necessary in pursuit of income. So that's kind of that breakdown. I'll show you an example of kind of what we dive into on the retirement and tax-free wealth strategies when it comes to planning your future, mainly diving into the Roth accounts, the solo 401ks, maybe even setting up a trust solo 401k, which is huge, and utilizing life insurance, which I think is a big part of a preservation strategy, if you will, or a tax-free wealth strategy. Based on what you see here, with a solo 401k trust, you can really get detailed when it comes to being able to structure deductions and structure the ability to invest on the back end, right? So you can get the deduction on the front end and really invest in things like real estate, like oil and gas, like cryptocurrency, right? A lot of these things that you guys are into and pursuing. There's a better way to invest in those things, and this is kind of an example of that setup. Corporate structures and trusts, right? I think it being in real estate, there's a lot of liability, right? You're literally owning the home that somebody else is living in. And if you don't have that set up correctly, there could be a lot of liability placed on you as the homeowner. But if you move it into a holding company or a separate LLC, again, it creates that layer of protection, right? I'm sure these guys have talked about maybe even setting up Wyoming entities, Wyoming companies to create that anonymity when it comes to, again, protection. And then being able to, utilize operating entities, family management companies to be able to pay your kids and different things like that. I'm sure a lot of individuals that are married or have kids, hopefully you're taking advantage of paying your kids, right? Putting them to work, teaching them early. But that's a big piece of the strategies that we dive into. This is kind of an example of a corporate structure, if you will, an organizational structure of how we set up some of our clients with the trust at the top, the two holding companies for your active and your passive real estate, the family management company off to the side, and then the different assets you can have with crypto, real estate. You have your S Corp, things like that. And then turning hobbies into businesses. I think that's the most fun for me, right? I probably have 5 other businesses that I run because of the hobbies that I'm into, right? And that can be anything from traveling, skiing, snowboarding, backpacking, camping, hunting, whatever it may be that you're into. Wake surfing, we were just talking about that. Boating, right? Now there are stipulations when it comes to entertainment and things like that, but again, we help you work through that. And what this does is it creates other deductions for you to be able to offset your active income with sales and with door to door and things like that. So that's kind of what I wanted to dive into and show you real briefly. That's a lot of the things that we'll take our clients through, and really taking advantage of a lot of those things. I wanted to dive into real estate just a little bit, and then kind of give you guys a little call to action, give you guys a big discount here as with the Segway giveaway and everything like that. Make sure we treat you guys well over here. But as well, if any of you guys have questions, I don't know if the chat is open or if we already said that in the chat, but shoot questions in the chat, and I'll try and leave some 5 to 10 minutes to maybe jump through a lot of those questions. If that's okay, Yogi, Mitch. Sweet. Awesome. Yeah,
Yeah,
throw them in the
that sounds
chat.
awesome.
We'll start reviewing that here in 7 minutes or so. So some of these questions regarding real estate, and maybe this will answer some of your guys' questions and things like that. But I think one of the biggest things is how the tax code rewards real estate investors, right? I don't want to, without getting too deep into politics. You got to understand uh, who provides the tax code, right? Who provides the legislation to implement the tax code, to make changes to the Internal Revenue Code, and what their setup looks like, right? And a lot of them, even in the past, have owned real estate, right? Have developed the country. And so when you think of that, and you've probably heard this online and things like that too, but when you're providing for the economy, whether you're a business owner, real estate investor, entrepreneur, you're providing value to the economy. And so the legislation, the Internal Revenue Code, wants to reward that. So with real estate, you're providing housing, right? Because of that, you're going to be rewarded in the form of depreciation, in the form of being able to take additional deductions, in the form of accelerating depreciation on those properties, right? Which has probably been talked about in here, where, and this kind of will answer some other questions here, but specifically, being able to accelerate depreciation is a game changer when it comes to,
Yeah, I
Yogi
think
mentioned.
I think if you were to break down an example, Travis, of like, okay,
Yeah,
say I own just an example of like an average investment property and what it does for a person in their taxes. Because you're talking about some of this
okay.
lingo, some people might not understand, like depreciation, right? Interest paid. So there's certain things on an investment property that once again they reward you and let you do to save money in taxes because you're providing value, right? So give an example of some of those things that you just talked about.
Yeah. So let's say, you crush it this summer, and you have a lot of cash. Hopefully your front ends are good to where you have a lot of cash that you want to put down on a property. Now, let's say your tax liability end of the year is going to be $20,000 to $30,000 because you made several hundred thousands of dollars this year. Let's say you want to buy a property worth, what's the average? 350,
Yeah,
400,
say 400,000.
400,000. So you buy a property for $400,000. For the sake of this example, we'll use a down payment just of 10%, right? So 40,000. You put 40,000 down. Okay. Now, most of the time, that's not a tax deduction, that $40,000 down on the property. The way you get a deduction or get a write-off is through these things called depreciation, interest, these other expenses tied to the property. So at this point, a $400,000 property is usually, according to the IRS, it loses its value over 27 and a half years, right? Sometimes 39 years. So generally, all you would do is divide that 400,000 by 27 and a half or 39 years. And that's the amount that you can deduct in the form of depreciation, meaning it depreciated, it lost a value, right?
Which this is funny because it actually like appreciates, right? But for whatever
Right.
it's so some people kind of get confused here. It's just yeah, how it works is kind of wonky, but it just is what it is, you know. They'd say that it's going to depreciate even though it's going to appreciate.
Right, exactly. And why that is, that's unknown to, I think, a lot of people, except for the people that probably created that
Yeah.
specific code, right?
Incredible.
And the
We
internal
love
revenue.
it. Yeah.
Yeah, exactly.
Someone paid a lot of money for that. Someone lobbied the government is the reason
Yeah,
Yes.
why.
that's what it was. That's what it was. Exactly. So yeah, as your property is appreciating in value, increasing in value on paper, according to the Internal Revenue Code, it's losing value, right? So over that period of time, this is the difference. So 400,000, we'll go 27 and a half years. You're deducting about 14.5 a year in the form of depreciation, which is good for real estate investing. And I'll kind of come back to that. So traditionally, you're getting a $14,500 deduction in the form of depreciation, meaning that could potentially offset your income or
So
offset the income of the property.
to clarify this as well, because this always confuses a lot of people. I had a sales rep once upon a time go and buy like $20,000 worth of crap so that he could write it off his taxes. That doesn't mean all of a sudden you owe $20,000 less in taxes. In this situation, that doesn't mean you owe $14,500 less in taxes. It means whatever tax bracket you're in, you take that percentage of the 14,500. So if you're paying 35% taxes because you're making good money, it's saving you, I don't know, $6,200. If you're paying 20% taxes, that $14,500 deduction is saving you a little under $3,000 off the top of your taxes. So it's a sweet write-off, but I always want to clarify, like, it's not a dollar for dollar, like, hey, you're paying this much less in taxes.
Yeah, no, I love that. Thanks for clarifying. And I'll kind of show what this looks like. So let's say you buy the property. This is what it's traditionally done. You get the 14.5 in a deduction, right? Not taxes. Um, so great. That's awesome. If you don't do anything, that's great. Now, what is a cost segregation study, or what is accelerated depreciation? A cost segregation study is something that you can do on a piece of real estate. And what you're specifically doing is segregating the different components of the property and putting them into their own depreciation schedules, right? So a washer, a dryer, a water heater, a dishwasher, microwave, fridge, those are all components in a real estate property that depreciates, loses its value over the next 5 years, 10 years, right? And there's a price to that. So what you're doing is accelerating that. Instead of now taking 27 and a half years to depreciate $400,000, you're now taking 5, 10, 15 years to depreciate a lot of those components, right? A lot of those physical equipment, the washer, dryer, heater, those kind of things. And so generally the rule of thumb is about 20 to 30% of the property value. Now you have to leave the land value out of it. So you got to figure out the land value. But you can generally take about 20 to 30% of that $400,000 in the form of a depreciation deduction. That first year is generally what that comes out to be. So if you remember, that first number was 14.5. So we'll take that 400,000, do it on the low end, let's say 20%. After doing the cost segregation study, splitting everything up, putting them on their own depreciation schedules, and then accelerating it. So now we're going to accelerate it because of bonus depreciation. Trump included that in the Job Acts and tax cuts. We're hoping that he increases that bonus depreciation again this year. Again, not getting into politics or anything, but we're hoping. That amount is $80,000. So instead of the 14.5 in depreciation that we're taking year over year, that first year we can take $80,000 in a deduction, right? Now, going back to Yogi's point, if we have a 30% tax rate, that's a $24,000 tax savings strategy, right? So now if you owed $30,000 in taxes and we implemented this, you're saving 24, you only owe 6 now by doing this. So
yeah, you'll see
huge advantages.
you'll see a lot of real estate investors going crazy is towards the end of the year because they're trying to buy as much real estate as they can so that they can do the cost segregation and save a ton of money on next year's taxes.
Exactly.
A
So
massive savings,
yeah.
guys. Massive savings.
Now, how do you take advantage of something like this? You got to be a real estate professional, right? So that's a whole nother ball game that you got to play. um, into the IRS's hands a little bit, right? Being able to, you don't have to be a real estate agent, you don't have to be a mortgage broker or anything like that. You literally just have to put 750 hours in to real estate activities, as well as 50% or more of your time at work has to be into real estate. And so, have I implemented that with some of my clients in the door-to-door space? Yes, because you are looking for properties throughout the day, right? You're knocking on properties throughout the day. And so, can you set it up to be in your favor a little bit? Yes, there are ways to do that.
Let's can we hammer through some of these questions?
Let's do it.
Are there any differences with taxes if you're investing in Section 8 homes?
As far as real estate, it's pretty much all the same. You will eventually, depending on the area, you can qualify for different tax credits because now you're into the Affordable Housing Act, and so you could potentially apply and be granted tax credits because you're investing in, again, the affordable housing HUD, everything like that. So yeah, there are a few differences there.
What's the most common deduction my accountant is missing right now?
The most common deduction that your accountant is missing right now, I would have to say, I think just structuring you properly to even take advantage of some of these other hobbies that you're in. I think that's what a lot of people aren't taking advantage of. It's just turning your hobbies into businesses. It's entertainment. We can't take advantage of that. But most accountants, most CPAs won't dive into that.
Yeah. A question I have that I think I'd love to hear your take on is 1099 employees, and let's use sales reps for example.
Yeah.
What are the most common mistakes you see them make that they do or don't do?
Yeah, not establishing an LLC right away. I think that's the biggest thing. That hardly costs anything, right? Maybe a couple $100 to establish it, a couple $100 to the state to establish it. That I have seen protect more people when it comes to litigation, when it comes to people coming after you, time and time again, to where
So
that's the number one thing.
what percent of 1099 employees should have an LLC?
All of them, 100, 100.
100%. Like,
Yeah.
hopefully, you guys, if you don't have one set up and have it tied to how you're getting paid, you'll get an EIN number, and you'll once again, like if you're with Aptiv, you can set that all up right now and set it up through your bank account to make sure it's all structurally or it's all done right. But everyone should have an LLC, so that's good. What are the biggest that's things that they should do and that they shouldn't do? What other big mistakes do you see 1099 people do?
Mixing mingling their funds, right? So it's correlated with your LLC. If you have an LLC and you don't have a business bank account, you don't have a business credit card, you're now piercing that corporate veil. The limited liability company has no protection over you. You don't have any protection. So it's commingling funds. I think that's one of the other biggest mistakes that I've seen, and keeping things separate, not
I
piercing that corporate veil.
I definitely commingle a little bit. I gotta stop commingling.
Yogi, come on, man.
We
I don't
got a
know.
guy named Joseph Smith that asked, "How hard is it to get an alliodial title on property?" I had to chat GPT this. Chat GPT calls it imaginary in today's world. That means that you own the property free of taxes, free of insurance, free of anything. Like you own it. It says it's virtually impossible in today's world. I thought that was a unique question. Shout out to Joseph Smith.
Yeah, great
And,
question.
and great name.
Yeah, great name.
Great name.
Rosie says hi, Mitch.
Jorge said 1031 exchanges. Can we talk about those or how to pass it real estate onto your kids in a way so they don't pay taxes on the appreciation?
So a lot of times, because they're your kids, there's that step up, right? I don't know if anybody has heard. So you have a basis, you buy a property for $300,000. By the time you pass away, or if you pass away early on there and it's worth 1 million, there's $700,000, right, worth of taxable gains on that. But because they're your child, there's a way to set it up under a trust, if you will, to where there's that step up in basis to where now it's technically not that $300,000 anymore. It starts at that million when you pass away. And so there's whether, and I think that might be separate from a 1031.
Yeah.
Um, uh, so that's how you can get away with not paying taxes on the depreciation is through trust structures and things like that. A 1031 exchange is you have to use an intermediary company essentially that will hold the gains of the first property that you sell, and you only have a certain time frame, but usually it's only within a couple months that they hold it in escrow, and then that's the money that you use to purchase the next property that's a like kind property.
Yeah, you got to declare a property within like 45 days, and then you got to, or within like 2 or 3 months, and then you got to actually purchase a property within like 6 months or something like
One
that.
one question that I've had on 1031
Yeah.
exchanges, I actually did one of these last year, and I haven't known. So if I depreciate, so to give this example some wings, I had a property that I bought in Ashton, Idaho for $130,000. I probably put 25 grand into it, and I depreciated the property. I sold it for 180,000, and I 1031 exchanged all of the money into a duplex that I paid $330,000 for. Now, do I have to like on that duplex, can I now only depreciate, and you might not know the answer to this because I've done this and I should know, but I don't. So a lot of people probably don't. Do I have to take the duplex and subtract what I already depreciated? Like for example, can I now only depreciate $200,000 of the duplex, or am I able to kind of reset and depreciate all 330,000?
To answer your question, you can't take the full 330,000.
Okay,
That
that's what I thought.
depreciation carries over.
Well, what if Yogi just likes to keep double dipping and just does it anyway? I'm just joking.
I can't answer that.
Hey, I already got in trouble once. I told that story at the start. I'm by the
What other
boat.
questions?
Send
What
it
other
then.
questions do we have here?
Cedar's a kid. Cedar, what up? Cedar is looking at buying his first property. Cedar makes pretty good money. He's an electrician apprentice here in Idaho Falls. He also won some money from a crazy situation, and he's looking at buying his first property. He says, "Can you write off buying properties for your taxes?" So Cedar, Travis kind of punched on that a little bit, but yes, you can. A fourplex Cedar, in the example that Travis used a home that was 350,000, and you mentioned like $14,000 a year in income reduction or in taxable income reduction. So the fourplex that you're looking at, Cedar, it'd probably be like 25 to 30,000 a year. And if you're in the 20 to 25% tax bracket, that's an immediate savings of probably $4,000 to $5,000 a year in taxes, which is awesome. Travis, am I missing anything on that?
No, no, exactly. The biggest thing would be qualifying as a real estate professional to
But
be
even
able to.
Smart or not smart? I made 100 grand. My accountant says you should buy a truck to this is my first year breaking 6 figures. My accountant says, dude, save taxes, buy a truck. Smart or not smart?
It depends. It
I
depends.
want to get into real estate. I want to get into real estate.
Yes, buy a truck. Buy a truck.
I should
Right?
buy a truck. You think I should?
Yes. Here's why.
Oh,
Right? With real estate, with lending, right? Especially if you're using your tax returns, they will look at what you're writing off, right? They will look at your adjusted gross income, your taxable income. They will also add back depreciation, right? So this truck worth $60,000, $80,000, whatever it may be, if it's under Section 179 and we can get all 100% of that, then they will add that back as income. So really, on paper, your taxes, you have an $80,000 loss, an $80,000 deduction. But the lenders, the underwriters, they know that you really didn't spend that money. And so they'll add that back into your
what if
income.
I finance and have a big payment?
Mm. Then you're looking at DTI, right? Debt to
Yeah.
income ratio.
This is where I think people go wrong. They buy $100,000 Raptor and they have a big old fat payment with a gnarly interest rate.
Yeah, that's where I would suggest talking to a lender, right? On the tax side, it makes sense. On the DTI side, it depends on the interest rates at the time. It depends on the worth of the property. I would be hesitant to buy something that expensive, especially when you weigh out your DTI ratio and what that actually looks like.
DTI
But
is DTI is debt to income, guys. So that's one mistake that people make. If you're already able to write off a lot and you're not showing a lot in taxes, and then you go buy $100,000 truck and you finance it, and then you're not showing a ton of income, and on top of that, your debt to income is now not great because you have a big fat payment. It's going to be really hard to qualify for real estate. Like that's where I liked Travis's advice. Like sit down with a lender. Like it's from a tax side, yeah, cool, smart. From a lender side, they're probably going to say, "Well, how much are you trying to qualify for?" Okay, not smart. So it's a game, it's an act that you need to be conscientious in these decisions. I've watched them freaking totally ruin people from buying real estate.
He's all the
yeah,
way
a
downstairs
thousand
now.
percent. 1,000%. And honestly, when we start talking about real estate, especially primary residences, that type of thing, that's my first suggestion is, hey, let's get in touch with a lender, somebody that's into that space, you know,
Yeah.
creative financing, things like that, and actually dial in the numbers and see
Yeah,
what that looks like.
really good. Any other questions or like
I
smarter,
think
not
kind of
smart?
to build off of that, guys, one of the
Okay, go
things that we
for it.
talk about in Golden Door Academy, and one of the things that I've talked about with so many of you, is you really got to build out your team. We had Taylor on here last week. We'll have other lenders in the future. We got Travis on here this week, tax expert, tax pro. You want all these people in your corner. You want to have a great lender. You want to have a great tax specialist. You want to have a great inspector. You want to have a great property manager. Like it's all about knowing the right people. So much of what you do, so much of the income that you're able to build out and the scalability of your business is having the right team. And having the right team has made me a lot of money over the years, and not having the right team has lost me a lot of money over the years. So you really want to have the right people in your corner. And that's where, like, again, stoked. Thank you, Travis, for coming on here and sharing some of your wisdom, sharing some of your experts. I know we got a few people I saw up above that were asking about, costs and how they can get a hold of you, um, and Travis is going to join the school too. So, if you guys have more questions, make sure to ask questions in there, and I'm sure Travis can respond to a few, and we'll tag him. And Mitch and I can obviously help. But yeah, a lot of you guys are going to need to set up LLCs. You're going to need to set up your S corp, especially you rookie sales reps. And I mean, all of us should be looking to minimize the amount that we pay in taxes, and while we maximize our income.
I just put in the chat a link to the school. So if you haven't joined it, click it, join it. It's called Golden Door Academy. Um, we're gonna have a lot of cool stuff in there and trying to just give people access to experts like Yogi just touched on. Like building a team is crucial. So you can always go in there, ask questions. You're gonna have a ton of people like a Travis that can give you feedback and answers in talking about taxes. Travis, anything else that you'd like to go over or
Yeah,
say?
give everybody
Yeah.
the how we get a hold of you and all that stuff.
Yeah.
Yeah, no, exactly. No, I saw a couple of you guys asking about, when should you hire a tax professional, tax strategist. So what I want to do here, because Mitch and Yogi reached out, and I want to make sure that I'm taking care of all of you guys by taking care of them. And so these are two separate links, and this is kind of the pivotal point, if you will, is that 50K mark. So if you're making less than $50,000 this year or even last year, then click on that link. That'll take you to a checkout page, right? Where this is where we can dive in, look at your taxes. Okay, so this will include just filing taxes, looking at creating an LLC, those kind of things. And that's $400. Usually we charge about $1,000 for that. And so that's discounted because we are here, because we are in this group. Now, if you make over $50,000, at that point, you want to start diving into some strategies and some structure and actually looking at, hey, if I'm not spending all of my money to offset this $50,000, what can we implement to actually mitigate your tax liability? So that link with making over $50,000, that again takes you to a checkout page. That's just a deposit of $500 that will go towards, hey, any strategies that we implement with you. We work with our clients on a 12-month basis, so that'll be the start of that. After each of these, if you make that payment, it'll take you to my calendar specifically. Okay. I want to connect with each one of you individually, not send you to my sales team or onboarding team or anything like that. Again, I want to take care of you guys individually and make sure that we implement the best strategies possible based on your situation. So again, that first link, huge discount, $400. That'll be to file
Uh,
taxes.
throw your Instagram on there too.
Oh yeah, let's do
Yeah,
it.
That's
throw
one of
your
the
Just
things that,
straight.
as we were checking out a few people, both Mitch and I love Instagram, and we loved a lot of your videos and stuff. Travis is sharing a ton
Thank
of
you.
value and just promoting like smart financial decisions within the door-to-door community.
Yeah,
Yep.
no, and I love it. Again, I'm big on the education and informational piece, and that's what I want to do for each of you. A lot of people are young in this group, and I can't tell you, I wish I would have started earlier, honestly. And so that's the reason for starting now, right? Like Mitch mentioned earlier in this call, is you want to get these things established now, right? You're going to go sell, you're going to go work 12, 14-hour days for the next few months. And you don't want to worry about this come fall time when you're partying and recruiting and still busy, right? Traveling, going on incentive trips, things like that. Start now. That way you can get things established by the end of the second
Yeah, and
quarter,
the
right? I
biggest
think that's the
guys,
biggest
well,
thing.
exactly. And I'll finish with this. The biggest thing in getting your ducks in a row is starting to put your team together. And like we talked about, working with the lender and asking him questions, asking your accountant questions, your tax guy. So it's a team effort. But if you don't take action and you don't start actually putting thought and like setting up the LLC, it's going to cost you way more than just, you know, that then it'll just cost you way more than not just doing it. Like it's so like just if you bought a property, I shared on my Instagram the property I bought 10 years ago for 30 grand. We're under contract and I'm making 370,000 on that off that 30,000 10 years later. And it's because I was diligent. I got this stuff dialed right away so I could buy it. So anyway, Yogi, anything else?
No, just thank you, Travis. Anything else you want to add, Travis?
No, no, I think you
Okay.
guys have hit it on the head.
I'll send out these links in all of our group chats as well. I'm sure Mitch will too. But guys, take this serious. Like the last thing you want to do is go out and make a bunch of money and then not be strategically positioned for taxes. You want to have an S corp. You want to make sure that you're planning. You want to make sure that you're getting ahead. I met a kid the other day who he's a good friend of mine. I found out that he's done door to door for like 5 years, and I found out that he's never filed taxes. And it haunts him because now he can't go get loans. He knows that there's some big bill hanging over his head that's going to be full of fees. Like he's in trouble and he knows, but he's like, dude, it keeps me up. It gives me anxiety. Like I can't sleep. Like this is something that you want to prepare for. You want to plan for. You want to spend time now working through it, figuring it out, and putting yourself in a place to succeed. So take Travis serious, schedule one of those calls, hop on with him, get it done. You'll be glad you did.
Amen.
Okay, thanks guys. Appreciate you.
Thanks.
See you guys.